I'm going over 5 Canadian banks to see which one deserves my hard-earned cash. Coming up. Welcome to the channel where we talk about saving, making, and mastering your money. If you guys are into personal finance or personal development topics, please consider subscribing. So I wanted to take advantage of the current market situation, do something I've always wanted to do, which is to buy my first dividend-paying stock. If you guys don't know, dividends are basically money paid out to folks who own shares in a certain company. Lots of famous companies pay dividends. The first one that comes to mind is Apple. Dividends can be paid out quarterly or annually, and some even do them monthly. And a lot of people with a lot of money in these types of stocks can live off these dividends, and they become passive income. And anything that has passive income is definitely worth investigating. Now, I'm definitely not there yet, just buying my first stock now. Now, there are different schools of thought when it comes to dividends. Warren Buffett, probably the world's most famous investor, owns a company called Berkshire Hathaway. They do not pay dividends. As a business owner, Warren says, if I'm paying out dividends, that means that I can no longer grow my company, and any extra money that Warren makes, he believes should go into the growth of a company. However, for investors, there's something really nice about getting regular payments that you have to do nothing for. If you can get a dependable dividend-paying company with enough money in that company, especially if the company grows its dividend over time, you're setting yourself up for some nice passive income in the future. And of course, you can always reinvest your dividends. And that's the smart thing to do. So for this video, I'm going to focus on Canadian banks. And the reason I'm in Canadian companies is because I am Canadian and I can avoid paying the exchange rate for converting my money to US dollars and buying US companies. After I've kind of explored my options on the Canadian side, I will move south of the border. So Canadian banks and financial institutions are actually some of the best in the world. They pay a very steady dividend, and they were one of the few banks in the world during the 2008 financial crisis that didn't cut their dividend or defer their dividend altogether. So this is something that you definitely want to look for if you're looking to be someone who lives off your dividends, or just giving you confidence that these companies will pay their dividends even in times that are a little volatile or uncertain like we are in right now. In this video, I'm going to analyze 5 banks, which are Royal Bank, CIBC, TD Bank, Bank of Montreal, and Canadian Western Bank. And you'll see why I added that 5th one. I'm going to put the information in my analysis in a table. I'll put that up on the screen right away here. But before I do that, just know that all this information is current as of April 13th. And I did have to scour the internet and a few different websites to get everything that I needed in this table. All right, so here we go. So here's the table. Along the top, you'll see the stock price, the dividend paid per year per stock, and then the yield. The yield is simply the dividend in dollars over the stock price in dollars. So you can see that all of these banks have really good yields. The CIBC one especially is at 7%, but the reason for these great yields is because the stock price is low right now, market volatility and everything going on with COVID. So with this market uncertainty, we have to dig a little bit deeper. We're not going to invest our money in just any company at this point. So now I'm going to go through some of the ratios and share some rules of thumb. But please keep in mind, I am not a financial advisor. If you're interested in this kind of thing, please do your own research and understand that these rules of thumb vary from industry to industry, and there's always exceptions to these rules. So again, please do your research or ask somebody who knows. So first is the price to earnings ratio, or P over E. This is the share price relative to the earnings per share. Here you want a lower number. The rule of thumb is something below 20 or 25. It's a quick thing to look at to see if you want to dig deeper. This is like the first photo in Tinder. It makes you decide if you want to swipe left or right on a company. As you can see, all the banks are below 20, with the CWB being the lowest. Next is the PEG. PEG factors in the growth of the company, and sometimes people prefer this over the P to E ratio. A PEG under 1 means the company is growing faster than its P over E, which is a good sign. Next are the price to sales and price to book ratios. Price to sales is a ratio of stock price to revenue, so again, the lower the better. Under 1 is considered excellent. Price to book, or P to B ratio, is the stock price over the book value of the company, which is the carrying value of the company on the balance sheet. A low number here means that the company could be undervalued, which would be a good thing as an investor to want to invest in now. Next is the debt to equity ratio, and the numbers in this table refer to the debt as the long-term debt for the company. Now, right away I can kind of tell that this ratio can be manipulated in a few ways. Sometimes you'll see this number that includes short-term debt. Sometimes the equity, which is on the bottom, can include different types or streams of revenue. So I would take these numbers with a bit of a grain of salt, but essentially what you want is a low debt to equity ratio. However, sometimes companies have to borrow money or take on more debt to grow. So it's not necessarily a bad thing. It just depends on what kind of industry you're talking about. So I'm not too confident in this particular row, but it's just something worth noting anyway. So this is where I normally would have stopped my analysis and felt like I had a pretty good idea of which stocks I really wanted to dive into or which ones would be the best. However, with the market being volatile and uncertain the way it is right now, there are a couple more ratios I felt like I should check right after I hit that like button. The second last item is the free cash flow per share, which shows the amount of money in free cash flow the company has divided by the number of shares. This is important because if this number is lower than the dividend payment, it's a red flag. It means the company could choose to lower the dividend or would have to borrow money to pay the dividend. If you are flush with cash in this area, it gives you good certainty that the company will continue to pay its dividend. So you'll notice that TD actually has a free cash flow per share of $1.48, but its dividend is $3.16. This is a bit of a red flag, whereas you compare it to CIBC or Bank of Montreal, who have a lot of cash flow and should easily be able to pay their dividend. Lastly is the DGR streak, and DGR is a dividend growth rate. The DGR streak counts the number of years in a row that this company has raised its dividend. You can see that the first 4 banks have all raised their dividend the last 9 years. Before that, these banks held their dividend and didn't really cut their dividend. However, this is why I wanted to include Canadian Western Bank, because you can see that this stock has continued to grow its dividend for 28 straight years. If a company is able to grow its dividend for 28 straight years, this gives you a lot of confidence, and it shows you that the company has been able to weather the storm through thick or thin, good economy, bad economy, and has been able to keep paying that dividend. And if you're thinking of living off dividends, then that is a very, very good indicator. So those are the metrics that I was able to gather to kind of analyze these stocks. Looking at the different indicators, I'm thinking that Canadian Western Bank is probably my top pick, followed by CIBC or BMO. After that would be RBC, and then I'd put TD in last place just because its free cash flow is so low. I don't think I will be spreading my money across these banks. I might be looking a little bit closer at Canadian Western Bank and CIBC just because CIBC has that really attractive yield. I'll keep an eye on the stock market for the next few days, and I'm thinking I'll be putting some money into one of these banks before the weekend. I'll update you guys as to which one I invest in on my Monday video, which I've been coming out with every week. It summarizes the news on COVID and talks a little bit about its effect on the markets, and we do a little bit more of an investment discussion. If you guys are interested in that series, I'll leave a link to those videos at the end of this video. Well, I hope you guys have found this useful. If you guys have any questions or corrections, please leave me a comment below. Until next time, have a great week, spread the wealth, and I'll see you in the next one. Bye.